From the morning reading, the Dow hits 20,100. Dow Jones Industrial Average, Nasdaq make new all-time closing highs as the SPX pauses. VIX hits a 52-week low. Breadth weakened compared to the prior session as decliners led 1558 to 1440 on the New York Stock Exchange and led 1719 to 1066 on the Nasdaq. On the S&P 500 snapshot, a record intraday high, but a fractional loss for the day. The S&P 500 spent the day in the second narrowest trading range of the year between its 0.11% intraday high, a record intraday high, and a negative 0.19% intraday low. The index finished the session with a fractional 0.07% loss from yesterday's record close. Its elderly cousin, the Dow, still on steroids following its close above the popular 20,000 benchmark, posted a small gain of 0.16% to achieve another record close. In other news, individuals are losing their faith. The latest readings from the weekly American Association of Individual Investors survey showed a drop in bullish opinion among mostly self-directed investors. At the same time, everyone else remains steadfast and extremely bullish. While individuals are looking down upon as the dumb money, that has not been an accurate statement, especially over the past decade. Utilities are stuck. Despite breakouts to new all-time highs by its bigger brothers, the industrials and transports, the Dow Jones Utility Average, has been stuck below its 200-day average and above its 50-day average for nearly 30 days. Which way the index breaks out between those two averages has said a lot about which way it will most likely to continue to travel in the months ahead. Speaking of the industrials and transports, when they both closed at record highs together on December the 7th, we looked at how they tended to perform going forward. Mostly, they saw weakness over the shorter term, which was the case in December as well. Materials and technology have been doing well. Both of the S&P 500 sectors saw more than two-thirds of their component stocks set a 4-week high, more than half a 12-week high, and more than a third a 52-week high. Such thrusts have tended to lead to limited upside for both. Hello, this is Stephen Harris, the head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 5:51 a.m. Mountain Time, and I'm recording this in preparation for the market day of January the 27th, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and bounce over to the morning report. And at the time of this cut, all four of the U.S. broad-based indices were rotating around scratch. Crude oil is down about 0.75%. Euro is down just below scratch, as is the U.S. long bond. Gold is down about 0.2%. In overseas action, it looks like China might not be open. That's the data from the 26th, so it's probably a close. Hong Kong is down just below scratch. Japan up about a third. Germany is down just below scratch, as is the United Kingdom. In terms of macroeconomic reports of note for today in the United States, you have the advanced GDP and core durable goods orders. And University of Michigan consumer sentiment will be released after market opens. In terms of the current volatility conditions, short-term VIX down to a 9.71. The regular VIX had a new 52-week low with yesterday's session. The skew still above the first level of caution, coming in at a 129.58, so somewhat elevated, though not extreme. IV percentiles all still single digits. The S&P at a 7, the Russell at a 6, the Nasdaq at a 3, and the Dow at a 5. Standard deviation size moves on a close-to-close basis were nowhere to be found in the 4 indices yesterday, after 2 prior sessions in which all 4 of the indices had been making large moves. So a bit of a digestion day yesterday, which is very normal in a bull market, especially after a big breakout, an important breakout like you had across multiple indices. That we would have a day of digestion is in fact quite healthy for the bulls. Okay, let's go ahead and go to the charts. And the S&P, you can see we came right up within 2 ticks of that initial target at the big round number of 2,300 in the S&P futures chart. And just to see where that is on the SPY, 229.71 is the intraday high yesterday. And SPX, that would have traded at 2,300.99. So you see there's, when you talk about round numbers, it's an area, and in quotes, the round number means something different on various trading instruments. But we use for charting purposes primarily the S&P futures chart, and you can see where that turned. And this is where the big institutions are trading. In terms of the Dow, well, I guess one comment I'll make before I move on. You notice big breakout, and then 2, and this of course is a partial day candle, 2 dojis, so a little bit of consolidation. We sometimes refer to dojis as indecision. After this kind of a move, I think that a better description is probably one of digestion and not so much indecision. There really isn't much sign of weakness from the bulls at all at this point, other than the fact that we are up against this potential area of resistance. So in the Dow, of course, it also took off and had its own breakouts and has continued to build on that. And you know, sometimes these breakouts come back and retrace to the area of former resistance, now turns support. So far, we haven't seen any evidence of that this time. NASDAQ also continuing to break out, running up against this upper channel line at this point, and we'll continue to see if that has the same angle of bullishness and how long that can persist. Take a quick look at some of these primary contributors and look at Apple. Apple certainly is helping lead the way, and this is coming into earnings, so very, very strong move on Apple. Though remember, if we were to actually look at a multi-year, this is a 52-week high, and the short term is very strong, but Apple would still need to go up into the 130s to get to the comparable all-time high. Let's see, Netflix has also been trading near recent highs. This one's actually been the most bullish. Facebook still has a little bit of room to go, but it's getting close. Certainly we're within about 1% or so now. It's 52-week highs, also getting ready to come into earnings. So we could have some real volatility coming up in the NASDAQ as some of these large components are coming into their own earnings reports, as well as coming into former areas of resistance and near-term 52-week highs. And we'll take a look at Google. And look at this. Google also putting in quite a charge here in just the last few sessions. When it broke through this swing high, it did so with a very large effort. And you see it did have its earnings, and it blew past those earnings with a 936 actual versus a 765 estimate. So big move there. Okay, let's go ahead and go to the Russell. The Russell's been, after being so strong, the one that has been relatively weaker in recent trading weeks and has yet to break through this area of overhead resistance. And certainly, while it did break through the diagonal resistance, has not yet broken through the horizontal resistance or made a new swing high like all 3 of the other indices. So continue to watch that. In other markets, of Crude oil's been in a sideways consolidation pattern, and nothing has changed on that pattern. And gold looks to be truly giving back some of this counter trend move. We're going to watch to see just how far this goes. Do we get a higher low or do we get a lower low? It's going to be very interesting to see what happens with gold. Dollar seems to have a bit of an inflection point here, coming basically off of this swing low here. Looks like that has been an area of support. Also, you notice how that lines up with the bottom of the cloud. That would be a bit of an area of support and a bit of a bounce to the dollar. It certainly makes sense. Now, the question is, we've had these recent short-term lower lows, lower highs, and do we get a trend reversal, or does is this just a counter trend move in a larger time frame, or is this a total change of trend? So that's going to tell us an awful lot about what to expect in crude oil and gold, and then also in bonds. And of course, bonds has been also quite weak of late, and much like gold, we're looking to see, do we get a higher low or a lower low in the short-term trend? Okay, let's take a look at VIX. VIX, remarkable new lows. Anytime you get down here in these 10 handles, that is super, super, super low. So if you need any kind of hedge protection, you need to be buying any puts for your investment portfolio for long-term protection, this is the time to do it. You do it when things are complacent and the entire world looks like it's a safe place for the investor community. And these are super good prices. Insurance is on sale. Okay, let's see. I think that's probably enough on the charts. Let's go ahead and go to the daily report. And things continue to be quite bullish over here. We're currently market phase 4. Price patterns near resistance or extension patterns is your description. And that is bullish. And the 3 market timing signals, they're all certainly pointing to the bullish side, with the first 2 strongly bullish. The first one coming from IBD, confirmed uptrend, bullish. GMI index, a perfect 6 out of 6. And the second indicator, GMI2, is also a perfect 8 out of 8, with that buy signal being in place since 11:10. Stock charts decision point scoreboard is the in some ways the more refined indicator, in that it's not just basically a thumbs up, thumbs down for the most part. This one actually goes into the multiple time frames, into the multiple indices. And as such, it gives us information about what to expect in these different time frames. While we primarily trade on the intermediate term time frame here, it's always of interest to see do we have this stack. And a stack is when we have agreement between the signals across the 3 time frames. And the stack is woefully lacking here. And you see the short term and the long term is showing mixed signals across all these different indices. As such, the expectation is, frankly, very much what we've been getting. And that is that we're going to get a lot of kind of sideways action with incremental new highs. We certainly have a bullish bias, but also relatively shallow lows. And that's, the high probability type of move. The other thing to keep in mind is that when the VIX is at 10.5, you're not likely to get a very large move either way without some sort of new news or information or something to drive energy and momentum into the market. With volatility measures coming in that low, that has an effect both on up moves and down moves. Keep that in mind. Position sizing opinion models, both models coming in at 100%. The intermediate term market posture, exceptionally strong bull, especially with our benchmark coming in, closing in on a 90. And that's further supported by our longer term indicator, an exceptionally strong bullish sentiment line. That further reinforces and tells us to expect that any pullbacks, drawdowns, etc., are likely to be relatively shallow and short in duration. Now, that doesn't mean that this bull market can just go up forever. We will get pullbacks and corrections. And indeed, seasonality, as well as the number of days that we've actually been in this pattern, start to increasingly call for something of a pullback. So that's one of the tricky things. And indeed, as we come down here to our opinions, we've been really quite conservative through much of this move once we settled in the post-election rally and that sideways move. We went relatively conservative with the 1-to-1 ratio of out of the money, in the money strikes, and a 1-to-1 ratio of high beta and low beta. And this is in recognition that it's very difficult to continue to be piling on new positions when you're this extended. And you should be expecting at some point something of a pullback. So especially when you're talking about swing trading, and I probably ought to put an opinion here for swing trading. I'll have to think about that. But in terms of short-term, days to weeks, bullish swing trading, where you've got to get a move or your options just kind of often evaporate in their value, it's hard to have a move right now at this point of an extension of this rally. So while we still in the bigger picture, intermediate to long term, have this very solid bullish expectation, if you've got to get there and you've got to get there in the next 2 or 3 weeks, you may find that that's getting to be a pretty big ask in these kinds of market conditions. So kind of keep that in mind. If we do get that pullback, that's going to be a beautiful opportunity to add to your put positions. So consider that as well. Be patient and look for individual chart setups, but also look for broader market setups to bring this into play during an overall context of a bull market. In terms of option income strategies, this is the one with the asterisk on it. We're well below the acceptable range to initiate new positions for novice traders. And then we've been talking about this in recent sessions if you listened every day. Very difficult to get enough premium to justify the amount of risk that you're taking on for novice traders. So just kind of keep that in mind. Maybe you reduce your position size. In terms of specific areas of warning, mostly related, as it's been common lately, to expectations of increasing volatility at some point, but recognizing at the same time that that can be long in coming sometimes. We can be very low volatility, waiting for that expansion in volatility for persistent periods of time at times, especially during summer doldrums or like the Christmas holidays. Not this time of year so much so, but this can persist for a period of time, so just kind of keep that in mind. The volatility is likely to be caused by something where the administration kind of shakes things up. Obviously, there's a lot of things happening in the first 100 days, a lot of activity in the legislature now. So we're likely to see that start to reverberate through the markets, and both positive and negative, and start to see some increasing volatility during those first 100 days. Distribution day count on the NASDAQ persists to be high. It's relatively high at a 6 right now, and certainly in the warning area. Skew a bit elevated, so a number of kind of mild warnings here. In the trend base, everything looks fine here. In the intermarket risk aversion indicators, we've actually gone to 4 on, risk on, and only 1 risk off, so this has actually been improving for the bulls. In terms of sentiment, basically neutral to slight elevation, and you see the same thing in the fear and greed index of 57, so just above neutral there, nothing particularly extreme, and that's where we start to pay more attention to sentiment. In terms of overall performance by sector, you see the overall day was essentially scratch, with consumer discretionary, materials, industrials, financials, so all risk-on sectors being the better performers. More marginal performers, telecom, utilities, real estate, consumer staples, all your defensive are down here in the bottom half. Healthcare continues to be pummeled, and if you're investing a whole lot or doing a lot of swing trading in healthcare, I hope you're doing it to the bearish side. This continues to be a sector that does not have many friends in the media and politics and in the investor community, you're just slogging a tough road if you want to be an investor in this community. In terms of market posture by time frame, market posture by sector specific time frame, you can see healthcare, utilities, and retail are primarily our areas of weakness, with others to various degrees strong, strong, and strong. Percent change have been focusing lately on this 1 month. You see the 5-day where we had the breakout. Well, who were the breakout leaders? Well, that was materials, and we did talk about DRI, DR Horton, DHI, I think it is. I'm sorry on that symbol. But DR Horton, the home builder, certainly leading part of that charge. But materials have been doing very strong. You see the 5-day and the 1 month. And then also technology has been a pretty consistent, strong performer in that time frame. So continue to keep your focus on those. And then, of course, within the financials, especially the regional banks, though they've slowed somewhat of late, they certainly have been an area of good performance. Also, consumer discretionary, 2% in the last 5 days, over 3% in the 1 month, almost 8% in the 3 month. This is not a slackard either, and it's been relatively consistent in performance. So carve up these sectors, look at the industry groups, the individual holdings within here for some of the best potential setups going forward. Okay, that's just over 20 minutes. We don't like to go over 20 minutes, so let me go ahead and roll this thing up. I'm going to show a few slides here with some additional information. If you need to pause to be able to get that information, just do that. You'll note that there's also hyperlinks on each of these slides to where you can get more detail about the room membership. There is a free trial available. And then, of course, the disclaimers. Hit the pause button if you need more time to read the disclaimers. Also note the hyperlink down here at the bottom of the slide for the full set of disclosures. We'll be back here next for Monday's market preview from Falcon Global. In the meantime, manage that risk profile. And as always, go out there and learn something about your trading and investing each and every trading session.